Before we begin this podcast, we'd like to remind listeners that Netwealth is licensed to provide general financial product advice only, and that this podcast isn't tailored to any particular person's objectives, financial situation, or needs. Before a listener acts on any advice in this podcast, they need to think about whether it's appropriate for their circumstances or their clients, and consider the product disclosure statement for any proposed investment, and also seek any professional advice they need. Netwealth Investments Limited is the issuer of Netwealth's financial products. For Netwealth's financial services guide, contact details, and other information about our products and services, you can visit our website at netwealth.com.au. Today's podcast guest is a financial product issuer. Netwealth and the guest have a commercial arrangement that enables investment in products managed by the guest through Netwealth's platform. Under that arrangement, Netwealth may receive fees from the podcast guest. More information about the fees Netwealth receives is provided in our financial services guide, which is available on our website or by contacting us.
Welcome to the Netwealth Portfolio Construction Podcast, brought to you by the Netwealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives.
Welcome to the Netwealth Portfolio Construction Podcast series. My name is Paul O'Connor, and I'm Head of Investment Management and Research at Netwealth. In my role here, I manage and govern the investments that are made available to you through the Netwealth investment platforms. Today we have Roger Montgomery, Founder and Chief Investment Officer of Montgomery Investment Management. Welcome, Roger.
Good to be with you, Paul.
Montgomery have a number of Australian and international equity funds available on the Netwealth platform, so hence we thought it'd be prevalent to get Roger in to get his views on, I guess, the global economy and the Australian economy and an outlook for 2020. Starting with really, given the attention the coronavirus has been receiving in the mainstream press, what are your views on the economic impact to the global economy as a result of the pandemic that's unfolding at present?
So I've got a couple of perspectives on this. The first thing I want to say is there's this terrific little, story about a king once asking his advisors, thousands of years ago, asking his advisors to sum up the world and the future and everything in 4 words. And they came back to him and they said, this too will pass. So coronavirus will pass. That's the first thing to remember. And if you have that perspective, it allows you to realize that there could be lots of opportunities presented by when the market reacts negatively to a company saying, for example, yeah, look, we've been adversely impacted by this. So we saw, yesterday, Kogan, for example. We've seen lots of, or not yesterday, earlier in reporting season, we've seen lots of companies come out and say, yeah, we're seeing an impact. You think about a company like Lovisa, great retail opportunity, great growth prospects, and then very fast fashion, 78 new products a week. And so if China shuts down because of coronavirus, where do they get their product from? They don't have product to sell. So that's going to inhibit because their inventory turnover is so fast, it's going to inhibit their revenue generating ability. Is that permanent? Well, it depends on how long coronavirus lasts. But remember, this too will pass. Now, you asked me about the economy. What does it mean for the economy in Australia and maybe the rest of the world? Well, it could have a detrimental impact on growth. The longer it lasts, the worse that impact will be. But it doesn't really matter. Paul, what matters is how does it affect individual companies? And then you start to think, is it going to impact on companies permanently? No, it won't. Some it could. We know, for example, there are restaurants in Melbourne that have closed down.
Yeah, we've seen that in the media, a couple in Burke Street or Little Burke Street here in Chinatown.
Yeah, and maybe for different reasons, George Columbaris has gone. And retail's been doing it tough in Australia already, and so we've seen a lot of retailers go broke in Australia and close their doors permanently. So it's not just coronavirus. The point to make is that it will affect companies differently, and it's your job as an investor to think about how they're going to be impacted and ask yourself this one question: is it permanent? And if it isn't permanent, then it's probably an opportunity.
Yeah, interesting. And I think a timely reminder that equity markets continue to, I guess, overreact at times to short-term news.
That's what's so great about equity markets.
And that's where if you keep that long-term investment strategy, it does present an opportunity to good investors there. So
it just requires you to realize, ask yourself, how do I help investors think about how to think long-term? is to ask yourself, if I was a bear and I hibernated for 5 years, would this issue be gone when I wake up? You can almost guarantee we're not going to be talking about coronavirus in 5 years' time. And that's how to think about it.
No, we'll probably be talking about coronas, but a different type of corona
indeed.
there, Roger. Moving on to the US economy, what are your views at the moment on the US economy and the outlook, and particularly given, I think, the phase one of the trade deal with Trump?
Yep.
So the trade uncertainty and the trade war seems to be playing out there. So what are your views at the moment there?
Well, I think interest rates are going to stay low for a while, and that's because of a very high level of corporate debt. The economy itself, with the traditional measures that we look at, for example, retail sales, we look at employment. Employment's strong in the United States at the moment. They'd like it to be stronger, but it's not getting worse. Wages look like they're okay. It's not growing at a great rate of knots, but that's good. It's not inflationary, but it's not going backwards either. So you're in this sort of Goldilocks position where you've got low rates and the economy's plodding along. That's good. On the other hand, there are risks. There are risks around the level of corporate debt. There are risks around the bubble in private equity valuations. It's an enormous amount of money that's been poured into private equity. People have, en masse thought that it's going to be their road to riches. But the companies that they've supported are only making money, are only employing people because of the altruism of private equity investors. Eventually, when they run out of money, private equity investors don't want to put more money in, not at increasing valuations at least. You might find a lot of those people become unemployed, and that could change the unemployment picture for the United States, and we may end up with a recession down the track. But there's no risk of that at the moment.
Yeah, no, interesting your comment on private equity. We've certainly seen an increasing interest, a number of products available on our investment menu.
Yep.
But I guess as an investment consultant, the returns out of private equity as an asset class over the last decade have not been that great.
Well, they've been boosted by the fact you don't contribute all of your money up front. That's the big issue.
So true. And I think also impacted by who are you buying the equity off? And is it an investment bank or is it a family that's built up a business and looking to sell it and go public?
Paul, the big issue, which I talked about in our webinar recently was, the fact that this is an illiquid asset class. Now, I remember the GFC really, really well. I can remember investing through the GFC. And I remember that, there were funds around me that were closing. Liquidity there was no liquidity. They'd shut. They wouldn't allow redemptions at all. So what did people do? They got their money out of the funds that were performing really well. So here's a scenario. Let me paint a picture. If for whatever reason, whatever the left field black swan event is that triggers people to go risk off, they can't get their money out of private equity. So where will they get their money out of? They'll get it out of the other assets, equities, for example.
They're better quality assets typically was what they were selling.
Well, that's right.
To your point.
Yeah. And so they're going to take their money out of equities. And and you look at US equities, the top 10, the largest 10 US companies are on an aggregate P of 45. The top 10 Australian companies by size are on a P of 19. So US markets are pretty expensive. Now they're justified by low rates, but and it's true that the market has pretty much surmounted every obstacle put in front of it because of those low rates. It's ignored pretty much coronavirus. It's ignored presidential impeachment. It's ignored a trade war with China. It's ignored the, Korea sending missiles over Japan. It's ignored all these things. It's just kept going on its merry way because interest rates are low. But at some point, the prices get too high. And when they get too high, people start to say, you know what, maybe it's time for risk off. But I can't get out of private equity, and that's where a lot of my money is, so I'll take it out of equities.
An interesting point there about the valuations of the large or the mega cap companies listed on the US exchanges.
Yes.
the New York or the NASDAQ stock exchanges versus Australia's, I guess, top 20 companies listed there on the PE of 19 to, what was it, 44, 10, I think you mentioned. 45
for the US top 10 and 19 for the Australian top 10.
Yeah.
Big difference.
Absolutely. Sort of feeding a little bit off those comments there about the US economy. The current economic cycle, it's now 11 years long now, and I think it's the longest expansionary period ever recorded.
Yeah.
My view is that this will be a period studied very closely by finance and economists, academics over the years to come. Do you have any thoughts on what's really pushed the cycle out so long?
It's the greatest monetary experiment of all time, now called modern monetary theory. The idea is that the level of debt you accumulate as a sovereign doesn't matter. The amount of money that you print doesn't matter. How low you cut interest rates doesn't matter. Just keep doing it and keep kicking the can further down the road. That's what we're experiencing right now. Asset prices are high because interest rates have been cut so low that people don't want to keep their money in cash. And that's precisely what central banks wanted to do. They wanted to engineer a wealth effect. They wanted to engineer rising asset prices so people who had assets felt wealthier and then went and spent money. Hasn't worked. Hasn't really worked because we haven't had significant growth in economies. So it's really synthesized. It's artificial. It's gone much longer than any rational person would have thought that it would. You look at where Warren Buffett sits. Warren Buffett's arguably the smartest conventional or traditional investor in the world and the best performing one. Yes, there are companies like Renaissance Capital that run quant funds that have done better than Buffett. They had an appalling year last year. But over time they've done even better. But put that aside, let's look at somebody who just thinks about businesses and equities as pieces of businesses. Berkshire Hathaway sits at about 40% cash at the moment. 40% cash. That's telling.
And how would that compare to, I guess, historically their cash holdings?
In the GFC, during the GFC, he went down to about 8 or 10% cash. And now 40% cash. The largest single position in Berkshire's portfolio is cash. And that's telling. Forget about all the positive things he says about investing in America. Put that all to one side, all those sort of paternal statements, and just look at what he's doing. He's holding a lot of cash, can't find things to buy. He thinks the market's expensive, and he only puts that cash to work when it's cheap.
Yeah, it's interesting there. And I think, in my mind, the huge amount of debt built up that led into the financial crisis in 2008, has never been paid off. And in fact, it's simply been moved from the private sector to the public sector.
Correct,
and continued to increase.
Yeah, indeed.
Yeah, I think that's playing behind your comment, kicking the can down the road.
Yeah, indeed.
There. So
I don't know how it ends. I don't know if it does. Maybe it doesn't end in our lifetime.
Yeah.
But if you think the background to what's going on is, and that's not going to change, and that is that central banks are cutting rates to incentivize businesses to invest. The theory goes that by those businesses investing, they'll employ more people. But it's not happening. What's happening is they're investing in technology that displaces labor, that replaces people. And so central banks have to cut rates even further to try and get more people employed. And that's the difficulty. That's the corner that central banks have backed themselves into. So I don't see rates rising anytime soon. So for the time being, it's steady as she goes.
Now, moving on to the Australian economy, we continue to appear to muddle through and keep growing.
We seem to be lucky all the time.
We are the lucky economy. I guess, a saying that is quite in the front of my mind at the moment, that when China sneezes, Australia catches a cold.
Or catches coronavirus.
So what's your view on the outlook for the Australian economy over the year? And I guess given your earlier comments around the coronavirus, any sort of takeouts of the impact that will have on Australia, other than a couple of restaurants closing that we mentioned earlier?
Well, if the coronavirus issue lingers longer than SARS was an issue for about 3 or 4 months. Hard to compare the SARS coronavirus to the current coronavirus. And that's because you had the Iraq war at the time of SARS. Anyway, it went for 3 to 4 months. If this goes, the market is currently betting that the current coronavirus goes for a similar amount of time. If that's wrong, then the impact on the Australian economy will be felt in tourism. It will be felt in GDP. And I think that's why the Reserve Bank recently kept their powder dry and decided not to cut rates, because they wanted to be able to do so if it did get worse. Having said that, and there's an issue obviously for iron ore prices. If the lockdown in China continues, I'm getting some wrought iron work done on some gates at home back in Sydney. And I've got a Chinese factory. I've got an Australian designer who's using a Chinese factory. They have told us that, they told us back on the 3rd or 4th of January, that the factory would be closed until the 3rd or 4th of February, because they had Chinese New Year anyway. Then there was the coronavirus issue. So they said factory will reopen on the 10th of February. Now they're telling me the 22nd of February, and it could be longer than that. These sorts of things have an impact. Take Lovisa, and I talked about it in our recent webinar. But you look at retailers, for example, that have very high asset turnover. They're going to be adversely impacted. They can't get stock. You look at travel companies. Sydney Airport's going to be adversely impacted if Chinese tourists aren't coming to Australia. That's 10% of their inbound passengers. They spend an inordinate amount of money at the more expensive shops at Sydney Airport, at the international terminal. So, you look at individual companies, the longer this goes, it's going to have an adverse impact. Your question was about the economy as a whole. If I aggregated all the impacts on all the companies and on all the sectors, I would say it's a negative the longer it goes on. I just don't know how long it will go on. And wherever there's risk and volatility, there's opportunity. The green shoots are that we've seen dramatic increases in property prices in Sydney and Melbourne, for example, up 11% for the year, for the last 12 months. That's fantastic. That's going to have a positive influence on construction activity. We've already seen a little jump in approvals. That's going to lead to a jump in construction activity again, which slumped last year as we predicted it would. So we're sitting on about 18% cash, looking at where these opportunities are going to present themselves. Should we be buying CSR, the building products? Should we be buying James Hardie? Should we be looking at Flight Centre, who said the coronavirus is going to be a negative for them? We know in 5 years' time, coronavirus isn't an issue. Am I buying Flight Centre for the next month to hold for a month, or am I buying it for 5 or 10 years? Of course, I'm buying it for 5 or 10 years. So when we think through these issues, yes, coronavirus could be negative for the Australian economy, but it could be a huge positive for investors who think long term.
Before we bring you the second part of this chat, a little bit about who we are. Netwealth is an ASX-listed company established to help Australians take control of their financial futures. With a wide range of super and investment accounts, a huge variety of investment options and market-leading online tools, we can help you manage your wealth your way. Partner with us to see wealth differently and discover a brighter future. Visit the Netwealth website to learn more and get the PDS, which you should read before making a decision. Products issued by Netwealth Investments Limited.
Yeah, interesting points. And I guess the next question in my mind is the view that you have on the RBA and current interest rates. And I think given the comments you've made, the coronavirus and how long this plays out will be the number one determinant that the RBA will be looking at before they will make a call to further cut rates. Would that be right?
Yeah, I think the reason why they'll be reluctant to cut rates is property prices are picking up.
Yeah.
Mortgage brokers are reporting a lot more inbound inquiry. So we're starting to see, the bank sort of caught where it would like to cut rates because of coronavirus, but it can't because it risks fueling another property bubble. And so I think they're going to sit on their hands. They'll keep their powder dry. If the coronavirus issue gets really bad and it really affects our economy negatively, they probably will cut. But I think they're reluctant to, given the performance of housing.
Moving to the markets now, Do you think Australian or international equity markets offer better value? Which market do you think offers better value ultimately? And I guess out of the markets, what are the opportunities? What are the themes and the trends that you're observing? Yeah. And I guess uncovering in the fundamental research that your business undertakes on all the companies it invests in?
So in answer to the first question, I'll go, refer back to the comment that I made about how expensive some US companies are compared to Australia. Our 10 most expensive companies, or our 10 largest companies, are on a PE of 19 versus 45 for the US. So that's something to keep in mind. So there's always going to be opportunities in the US market. We've got a global team, a global investment team that are finding terrific opportunities even in an expensive market. And there's a lot more growth overseas than there is in Australia, because companies have longer runways. They're expanding faster. The US market is much bigger than the Australian market. And then they've got overseas to expand into, and they've got a good track record of doing that. In Australia, most of the growth has been coming from companies that do expand overseas. That's where a lot of the highest PE companies are in Australia, the ones that are looking at growth and succeeding overseas. That's the answer to the first question. I think there's probably slightly better value in Australia, but there's good growth in both markets, both economies, both jurisdictions. In terms of the second question, I do think that, how do I answer the second question? I think ultimately, if investors are cognizant of companies that downgrade, right? So you think about companies that downgrade as a consequence of coronavirus. You asked me about themes. Where do I see the themes? So if companies downgrade in reporting season now or in their outlook statements for FY20, and if they downgrade for FY20, analysts are going to have to downgrade FY21 as well, because you've got a lower base to start off in the current financial year. I think that's the theme to take advantage of. Ask yourself, is this permanent or is it temporary? It's probably temporary, and that presents an opportunity. So I think that's a great theme. Coronavirus providing opportunities amongst downgrading companies where the risk is temporary rather than permanent.
Yeah, interesting there. But I guess a couple of key points I take out of your comments there, Roger, in that, for starters, investors really need to consider having a good balance of both Australian and international equities in their portfolios. And regardless of the valuation of the market as a whole, there are always opportunities.
Which is what I was saying.
When you're undertaking that fundamental research on all of the stocks that you're looking at and buying in your portfolio.
You're absolutely right. And what I think you're alluding to is that growth and value are two sides of the same coin. If you've got solid growth, you can find value. If you've got a company that's growing very strongly, even if the share price has gone up a lot, it still could be very cheap.
No, interesting. Just briefly, have you got any comments or thoughts on Australia's major banks? And given all the, the press coverage that they've received over the last couple of years, whether you think the worst is behind them, but also what is the impact of the non-traditional lenders that are growing in the market, like a Latitude or an Afterpay?
Yep. So I'll answer the second question first. So in terms of, fintechs and startups that are nipping at the heels of the market shares of the four big banks, let's never ever forget the amount of inertia that people have with their bank accounts. You think about it, Paul. You think about if I said to you today,
I'm guilty of inertia with my own bank account.
Think about the palaver you have to go through to change banks, especially when you're my age and you've got a family trust, or you've got a corporate beneficiary, or you've got, your companies that you're working for.
Bills are getting paid out of it on
all
automatic
your different,
debit.
You've got all your debit cards and you've got your passwords, and the banks know that. And do you know what? So you compare that to the fact that it's not really much better anywhere else, and you get inertia. People don't move. So think about Oz Forex. Remember the Oz Forex business?
I do.
Everyone said that they were going to massively disrupt foreign currency transactions for banks, which is a very lucrative earner for banks, right? They give you terrible rates when you're trying to switch currency with a major bank. They don't care. The fear was that that Oz4X would take massive market share for the banks, and they haven't. They've got maybe 4% share or 5% share, and I could be wrong on that, but that was the last time I looked. It was a couple of years ago. It's not worth the banks changing their model for a company that's got 4 or 5%. So when we talk about other disruptors like Latitude and so on, you've got to ask yourself, how much market share do I think they're going to take? And if it's only 4 or 5%, you get two things. You get the banks surviving and prospering, and you get those companies still doing really well. They're growing off a low base. They'll still grow very fast. You can make money off both. Now, back to your first question, what do I think their prospects are? What do I think about them? I think the next 5 years and we're 2 years into it now. So I think the next 3 years, the remaining 3 years is still going to be tough for the banks. I think their credit growth is not going to be as fast as it was before. And I think their net interest margins is not going to be as attractive as they were before. And I also think that they've got increased compliance costs that are permanent associated with the Royal Commission. That's not going away anytime soon. And finally, I actually think that they've got record low levels of provisions for bad and doubtful debts at precisely the time that those things could start increasing. Yeah. So there's pressure on the banks. I think that's where the opportunity is. I think there's so much money in tech that any sort of disruption to the tech story, you might see money being pulled out of those high risk, high beta plays and move into more defensive stocks, and the banks are sitting there as prime candidates to receive that money.
And
institutions are underweight.
Great profit.
Earning great profits, and the institutions are underweight.
Yeah.
We've got the 4 banks are 27% of the index, and we've currently got 4% of our portfolio, 5% in the banks. We're incredibly underweight.
Very interesting. From an overall portfolio perspective, would you say then that your 18% cash is a defensive position or an opportunistic position, given some of the comments you've made about the shorter term risks and volatility that then creates a buying opportunity?
So having any cash is a huge drag on returns. Being in the stock market is much better in the long run than being in cash. There's no doubt about that. But it does give you optionality. It allows you to take advantage of lower prices when they present themselves. We saw in the December quarter of 2018, the Aussie market came off about 9%. The Montgomery fund was only down about 5% during that time, or 5.7% or thereabouts. And that's because of that cash. It provided a buffer. I'd rather not have the cash. I'd rather find opportunities that are attractive. But in the absence of finding attractive opportunities, I don't want to buy our 37th best thing. I'd rather put our clients' money somewhere safe, and cash provides that safety.
Yeah, interesting.
And remember, Buffett's got 40% cash at the moment.
Yeah. And I guess in my experience, I do find that many active fund managers feel compelled to invest 100% of their portfolio into the equity or
that's
listed
their mandate.
property or what have you. But I guess even managers that do have a little bit of tolerance in the mandate, they're very wary to make that call. So that really does set you apart, I think, from a lot of the other managers that we have available on our platform.
Well, I mean it with all sincerity. You've raised, a massive differentiator. It's a huge business risk to a funds management firm to underperform the index, right? You'll have a lot of clients leaving if you underperform the index. So you have to be invested because you can't take that risk. At Montgomery, we do things a bit differently. We know our clients. We've grown a lot slower than other fund managers because we only want to invest for people who understand that 3 years out of 10, we will underperform because we're willing to hold a lot of cash. So when we don't appeal to everyone, we play a particular role in a portfolio, and we only want to invest for people who understand that we've got that cash flexibility, which means that we will underperform when markets are booming, but we expect to outperform materially when markets are in more challenging times. And we've seen that over the course of, we've outperformed the market since the inception of the fund with 23% cash. But what we've delivered is 80% upside capture and only 58% downside capture. So when the market falls in any month, we've only captured 59% of that downside. And that's what clients really want. They want to go up with everyone else, but not go down with everyone else. And we've been able to deliver that.
Yeah, no, interesting. And I think in a closing remark there, my take out again, and certainly for the listeners, is that really we all need to make sure that we understand what we're investing in and the style of the manager.
Correct. It's got to fit.
And correct, it's then got to fit into the overall portfolio and what the need and objective of all of our listeners today are trying to achieve with their life. So on that note, I'll thank you for coming in, sharing the Portfolio Construction podcast with us, Roger.
Delight to be with you again, Paul.
Some really interesting comments. Thank you very much and have a great afternoon.
And you too.
Thanks for listening to this episode of the NetWealth Portfolio Construction podcast series. For more episodes and to subscribe to our series, visit our website www.netwealth.com.au or visit the iTunes Store or Spotify. We hope you can tune into our next episode.